Once the identity of the India Inc. Has now entered turbulent weather, majority of the IT large caps posted dismal numbers in their first quarter, while Infosys and Cognizant have cut their guidance for FY17. Wipro has forecasted a muted quarter ahead as well. To discuss this and more, joining me now is Urmil Shah, he's research analyst at IDBI Capital. Good morning, Urmil. It's good to have you on the show. Let's start off with what you have made of the overall IT earnings, especially the larger players, given the fact that Infosys has cut revenue guidance going ahead, and overall the environment has been somber for the majors.
Yeah, so as you rightly said, there has been a mixed performance as regards the Q1 FY17 results as well as the FY17 outlook. So amongst the large caps, we felt like HCL was the only company which at least met, in fact, beat the expectations, our expectation as well as the street expectations across revenue, margin, and the outlook. TCS was mixed. Revenue was slightly lower, while margin and the earnings growth was ahead of our expectation. And the other companies, were a miss on most of the fronts. And yes, Infosys cutting its guidance was also a disappointment, and we have subsequently cut our earnings forecast for FY17 and 18. But we still believe that Infosys should be able to meet the sector growth on a 2-year CAGR basis. So we continue to like Infy and HCL Tech amongst the large caps. We also like TCS, but it only because of it trading at 18 times FY18 earnings. That's why on a valuation front, it doesn't come in our topic.
Right. Urmil, you spoke about HCL Tech as well, and focus on the dollar revenue growth. I mean, in its peerage, HCL Tech has yielded a 6.5% dollar revenue growth. Do you think that for HCL Tech specifically, this is anomalous and it will fall in line in the longer run to a moderated stream of dollar revenue growth going ahead? Or do you think that HCL Tech is clearly one of the leaders from among the larger players?
So if you see specifically for HCL Tech, the previous 2 to 3 quarters, despite they having one large deals, that was not coming into the revenue growth. They have delivered it this time. Also, the consolidation of Volvo's IT business aided to the growth in Q1. So we believe that the momentum should continue in the second quarter as well, which is seasonally the best quarter. And the full year outlook as well, combined with the Volvo's IT business, we think that HCL should go faster than the 10 to 12% industry growth rate.
Right. Attrition also has been quite a major issue, especially for something like an Infosys. How much of a problem do you think? Because TCS has been relatively better on the attrition front, but when it comes to Infosys, about attrition as well as utilization levels?
So utilization levels have been good for all the large caps. I agree on the attrition front. While Q1 is generally a quarter wherein the attrition increases, but still on a directional basis, it's only TCS who has been able to bring it down substantially. So that remains monitorable for us. We are hopeful that as we go into the year, companies like Infosys would moderate their attrition.
Right. In this quarter, Urmil, also components like the wage hike that was undertaken, the visa costs, as well as the currency movements were also factors in terms of the margin performance. Going ahead, do you think that there will be a moderation from some of these exogenous variables on the margins?
So from the 3 factors which you mentioned, the visa cost will be, the impact will not be there in the subsequent quarters. As regards the salary hikes for companies like Wipro and HCL, the impact might be there even in Q2. But more importantly, the cross-currency volatility, if you see, the volatility increased only in the last week or so of the quarter. So Q1 in fact had a cross-currency benefit, but for Q2 and for the year as a whole, based on the closing rates of Q1 FY17, there should be a impact of cross-currency on the revenue and as well as on the margin. So visa cost and salary hike might not be having any impact going forward, but cross-currency movement will have an impact.
All right, let's also talk about the big news about Infosys as well. On back of the calling off of the RBS deal, the company has obviously clarified that there will be no employee hit that they'll be taking on those 3,000 employees, and they'll be reallocated elsewhere. But in terms of the guidance, do you feel that more of this is yet to come? Is this only a standalone case, or many more such concerns can emerge from Europe? And in terms of the guidance as well, do you think that Infosys is up for another revision going ahead for FY17 on the lower side?
So purely based on the contract, one of the contract from RBS going down, we do not think that Infosys will need to again revise its guidance going forward. We are building in a 10.8% constant currency growth for FY17, which is a tag higher than the lower end of the band. So for now, we are confident that they should be able to meet at least what is at the lower end of the band for FY17. So we don't see the RBS contract related stuff having a similar impact having on the other clients as well. But there is one thing which we need to monitor for the sector as a whole, along with Infosys. Q3 is generally a weak quarter for the industry, and there is when we believe that the impact of Brexit might be visible. So Q1 at least, Q1 and Q2 at least, we believe that growth will be quite good for the sector. Q3 onwards is where we believe that there could be some headwinds. And that's why we believe that next couple of quarters is a time for stock picking, and also we are not making any substantial changes in our recommendations because we believe that there will be quite a bit of time opportunity for doing the stock picking.
Right. Urmil, since you spoke about Brexit concerns emerging from the third quarter onwards, what are the companies from the overall firmament that you believe are most exposed to that risk going ahead? I mean, till now there has not been any articulate pronouncement of what the risks can be, or in terms of numbers, that hasn't been shared from the management. But some companies like Tech Mahindra, I mean, they have gone in for acquisitions even in UK till as early as a fortnight before Brexit. What is your view there? Certain companies to look out for on the downside?
So I would say Brexit could have impact as regards two areas. One would be the UK revenue itself, and the second part would be the BFSI clients. Because all the clients have global BFSI clients have global presence. So BFSI as a vertical and UK as a region is where there could be some impact. What we believe is that it's basically the shift from plan A to plan B is what the clients will need to do, and as a result there could be near term wait and watch kind of thing which they might take, and that's why ramp up of new deals or the existing deals might slow a bit right now. We do not see contract cancellation as such happening in a significant manner. because at the end of the day, both run the business and for shift to digital, the clients cannot take absolutely 1 or 2 quarter view. It will be just a near-term wait and watch, which they might take into account. So given this background, if you see TCS has highest exposure to BFSI, and they also have a good presence in UK and Europe. So amongst the large cap, they need to be monitored. But based on what their interaction has been with the clients in Q1, at least for now, they haven't seen any alarming, news or alarming discussions with the clients.